Are accelerators and incubators a fast track to funding or just a costly distraction? In this episode of Capital Compass, we break down the differences between accelerators and incubators, what founders should look for in each, and how to decide if they're really worth the equity. We also walk you through how to use these programs effectively, including the demo day strategy, investor networking strategy, and programming your return on investment. Whether you are applying to Y Combinator, Techstars, or any other incubator, this episode will help you evaluate the real value that accelerators or incubators bring to your startup. Accelerators versus incubators. Are they really worth it for fundraising? Are accelerators and incubators a shortcut to successful fundraising, or are they just expensive detours? In this episode of Capital Compass, we break down when these programs help, when they don't, and how to choose wisely. Let's start by understanding what are accelerators and what are incubators. Now, both accelerators and incubators aim to support early stage founders, but they are not the same thing. Accelerators are structured programs, often 8 to 12 weeks, with defined curriculum, demo day, and equity investment. Incubators are often ongoing, they are less structured, they're focused on workspace and mentorship, and they don't always lead to investment. As a quick comparison between the accelerators and incubators in terms of their time, the funding, the demo day, and network strength. As you can see, the accelerators are time-bound, the incubators are not. When we are talking about funding, the accelerators do fund, but the incubators may or may not fund. When we are talking about the demo day, accelerators have a defined demo day. With incubators, that's a rare occurrence. And when we are talking about the network strength, the accelerator network strength is often strong, but when we are talking about incubators, it varies widely. Why do founders really join these programs? Founders join these programs for a few key reasons. There is access to investor network, there is a structured mentorship, it builds credibility and brand signal, there is an urgency that is created through the demo day, and the small capital injection helps buy you time. And sometimes joining an accelerator is the easiest way to not die. What to evaluate before you really apply to an accelerator or an incubator? So not all programs are created equal. Here's what you need to assess. First and foremost, the percentage of companies that are able to raise 1 million post-program. The investor attendance at demo day, the value of mentorship or the track record of the partners, bench strength and competition, and then the equity ask versus the cash offered. Make sure that you don't go by one breakout company. You look at the median outcome.